Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz. Today winter has started and it is December 1 and this is a weekly markets update. Let's have a look at the news of week 48 and see what are the next trends. In urea market, the Indian purchase tender was finalized last week with 1,560,000 tons of acceptances. Even with quite aggressive L1, India succeeded to guarantee enough supply in order not to rush immediately into the next tender. With current level of stocks and tender result, India will need about 1 million tons more until the end of Q1. It means that next tender likely will be announced at the beginning of January. So, as we see, the puzzle of last week was solved by global suppliers to the tender. They decided to support the proposed price level and actually agreed for price reset. Supply geography will be dominated by Middle East with about 600,000 tons of product and Russia with about 400,000 tons. Chinese producers will not be able to supply more than about 300,000 tons because of logistical difficulties. As we discussed last week, latest export quota was split between too many suppliers and it makes it very tough to put together large vessels in time. European purchasing was almost non-existing last week, as pre-CBAM purchasing window closed. There was only one small sales registered in Egypt, where MOPCO sold 5,000 tons cargo at $460 FOB. But this level is definitely not representative. Actual bids were at the level of 440s and evaporated quickly in the course of the week. So, further downward correction is inevitable. There were no fresh deals registered in the Black Sea, but FOB level is evaluated around $410 and decreasing. Iranian producers haven't succeeded to sell at target level of $377 FOB. But one more cargo was sold to Turkey. It will arrive at around $420 CFR level. Demand in Brazil continued to be slow. Offer levels slipped more to $405 to $15 CFR range for non-sanctioned products. US market was also slow last week due to Thanksgiving holidays. However, several December barges were traded at low 370s level per short ton, which shows a decrease from a week ago. January tons were also traded lower. So, general market trend turned to bearish, and the only question is where the market will find the floor. Demand in December across the globe will be slow and might pick up only second half of January. Also, it will largely depend on European buyers' behavior following CBAM introduction, which is still unknown. In ammonium sulfate market, the phenomena of price parity for crystal and granular product continued. Copper-grade crystal price in China increased slightly last week to $163 to $66 FOB range. This increase happened on the background of tightening supply. At the same time, Brazil continued to evaluate its options in purchasing either sulfate or urea, so the demand was rather subdued. However, tighter supply of crystal pushed the granular price also up to the range of $160 to $65 FOB, which translated to Brazilian offers at $175 to $85 CFR. Elsewhere globally, demand remained subdued. In nitrates market, abrupt additional demand from the US following the explosion at the CF Yazoo facility pushed Baltic price more last week to the range of $250 to $70. Brazilian buyers were also competing for Baltic tons. CFR price to Brazil climbed by $5 to over $300, while November import volumes increased significantly versus a year ago. Bullish trend is expected to persist as domestic season in Russia is approaching quickly and export amounts will decrease. European producers are sold out until the end of the year and affordability remains low. However, buyers are still purchasing. Now February months, in order to secure tons for the season ahead. In the ammonia market, there were no major changes last week. The demand is generally weak, and prices stalled everywhere except Middle East, where fresh level is rumored to be already at $500 FOB. All eyes are now at Gulf Coast ammonia plant in the US, which a week ago informed the market that it is in startup phase, and last week traders told about first commercial sales. It is still not 100% confirmed, but looks like pressure might be eased. Also this week we will know December Tampa price, which is widely expected to be a rollover from November. There is no clear signal from Trinidad regarding restart of nutrient plants production yet. At the same time, gas maintenance that started mid-November there seemed to be finalized. European CFR price level hasn't changed and stayed at $690 to $95 level, as there were no fresh deals. The demand is subdued in front of CBAM. Meanwhile, Egyptian Abu Qir and Turkish Gemlik will have cargoes for December as per information from the market. Demand in India is also seasonally low, however spot price climbed to $480 to $510 CFR amid tight availability in the region. In fact, only China has some product to cover spot demand now. Phosphates activity remained subdued and prices slipped more across the globe. Indian buyers face no pressure for immediate purchasing. EU buyers are navigating tariffs and CBAM. Brazil season is over. Indian price level assessment moved lower again to $687 to $95 CFR, but fresh spot business was very limited. One cargo was reported by Ma'aden to be sold at $680 level, but there are rumors of even lower offers. Severe port congestion continues to limit import interest, and discussions remain tentative with no firm price indications. Indian market is expected to stay quiet until mid of Q1 next year. Fertilizers Association of India conference later in December is expected to provide some insights into 2026 procurement plans. Egyptian NCIC sales tender that was closed last week still hasn't provided concluded sales prices, only rumors. DAP was heard to be sold at the level of $700 FOB, TSP at $530, and SSP at $180. This is a significant drop from the previous tender that happened 2 months ago. But still, this price level seems quite high on the current subdued market. In Bangladesh, delays persist in opening LCs for DAP cargoes awarded under the recent tender. Market sources report Chinese Zhangfang shipped 2 vessels, 40,000 tons each, and YUC shipped 1 vessel, also 40,000 tons. However, both unconfirmed. In Brazil, indications suggest MAP at $630 CFR, TSP at $510, and SSP 19% at $210. SSP prices are firming, likely driven by higher sulfur costs. Healthy stocks in bonded warehouses and buyers' resistance to purchasing more material amid growing affordability concerns have weighed on the market. In the US, there were no trades registered last week. In the potash segment, the main news came from China, where Chinese major importing consortium has settled 2026 annual contract price with Uralkali at the level of $348 CFR, which is almost a rollover from the previous price. This caught market by surprise as it happened earlier than expected. Now all eyes are on India, that will settle its annual contract next, and Indian importers view Chinese contract price as a benchmark for their own negotiations. Market expects formal negotiations to start at Fertilizers Association of India conference later in December. Moving to the fundamentals. European natural gas futures dropped more to 28.6 euros per megawatt hour on Friday as weak demand and hopes of a Ukraine peace deal weighed on the market. In Germany, Europe's largest gas consumer, temperatures are expected above average throughout the next 2 weeks. And the prospect of mild start to winter continued to weigh on both the day-ahead market and futures. Same trend for the vast majority of other European countries. Norwegian gas exports were strong during past week and LNG supplies were also steady. However, Europe's gas storage sites are now only 77% full, which is 9% lower than at this time last year. US natural gas futures, on the contrary, climbed more, above $4.7 per MMBTU, nearing their highest level since December 22, boosted by a shift toward colder weather across key consuming regions. Wintry conditions have already hit parts of the Midwest and East, and forecasts point to below normal temperatures in the Northeast and Great Lakes in the coming weeks. The European Centre model also turned colder for early December, showing stronger cold in the Northeast and Great Lakes. Rising LNG exports added further support, with flows from major US terminals averaging 18 billion cubic feet in November, up from the previous month's record. Even so, record production and healthy storage kept supplies comfortable. Output reached nearly 110 billion cubic feet in November, pushing inventories about 5% above average. Agricultural commodities future prices again moved differently last week. Wheat futures fell toward $5.2 per bushel on Thursday to a one-month low on rising supplies. The November WSD report pointed that global output and ending stocks are at record levels, increasing exportable availability. Meanwhile, Ukraine said it will not reinstate export limits for 25-26 year after a larger harvest and slower early season shipments, freeing more Black Sea volumes. Argentina raised its crop forecast to near records, and Russian shipments remain competitive and steady, together swelling flows into key buying regions and reducing urgency among importers. Buyers have paired forward cover, and a softer dollar has further lowered import costs, encouraging importers to press for cheaper domestic offers rather than restock. Weather risks in parts of the US and Argentina remain monitored, but so far have not produced material crop losses, leaving the market with ample near-term supplies. Corn futures rose to $4.35 per bushel, rebounding from one-month lows, as supplies available for immediate shipment have diminished, and buyers are paying up for prompt delivery. Ukrainian shipments remain well below last season's pace, removing cargoes that would normally ease global tightness. And US export demand has moved into that gap. In Brazil, domestic demand for ethanol and industrial crush has strengthened, while farmer selling has been subdued, and an export program running into year-end has pushed up local bids and port premiums. Weather risks from a possible La Niña and reports of constrained rail and port logistics raise the chance that new crop supplies will not quickly relieve the prompt squeeze. Soybean futures edged up to $11.38 per bushel, primarily driven by Chinese buying. Traders reported that China has purchased at least 10 cargoes of US soybeans since Tuesday last week, bringing total imports from late October to roughly 3.5 million tons, or about 30% of Beijing's 12 million ton procurement target. Following a call early last week between US President Donald Trump and Chinese officials, Trump said he urged China to accelerate and expand purchases of American goods. Meanwhile, in South America, Brazil's National Association of Grain Exporters revised November soybean exports down by 310,000 tons. But this is still up 88% from November 2024 figure. Moving to the shipping industry. The Drewry World Container Index decreased by 2%, which was primarily due to reduced rates on the Trans-Pacific and Asia-Europe trade routes. Spot rates on the Trans-Pacific route continued to decrease for the third consecutive week, with rates from Shanghai to New York falling by 6% and rates to Los Angeles reducing 4%. Same for the Asia-Europe trade route. After 6 weeks of continuous increase, spot rates decreased slightly last week. The national strike in Belgium has disrupted port operations and increased congestion at the port of Antwerp. This congestion is expected to worsen as a few carriers are planning to return to the Suez Canal route, which will further strain port efficiency, leading to longer delays and surging spot rates. Drewry's experts think the supply-demand balance to weaken in the next few quarters. The Baltic Exchange Dry Index increased more by almost 300 points last week. The Capesize market delivered a robust and increasingly confident performance across basins. The Panamax market held a steady tone through the week, supported by firm fundamentals in the US Gulf and US East Coast, while front-haul grains continued to underpin Atlantic sentiment. For Ultra-Supramax segment, it was a staggered week, with the Atlantic seeing a dip in activity with the Thanksgiving period at the end. The continent Mediterranean lacked fresh impetus, while the Asian basin remained relatively active. The Handysize segment remained broadly steady. In the continent and Mediterranean, inquiry remained limited, and sentiment softened midweek. Similar was in Asia. On the contrary, the South Atlantic and US Gulf were firmer ahead of the Thanksgiving period, supported by healthier demand. To sum up, global suppliers generally accepted urea price reset as a result of Indian urea purchase tender. More than 1.5 million of product was confirmed for shipment, despite quite an aggressive L1. And now, India will not have to rush into the next tender likely until beginning of January. Let's watch where urea price will find its floor, as global demand is expected to be subdued until beginning of next year. Ammonium sulfate price for standard and granular product continued to float in parity due to crystal supply tightness in China and subdued granular demand in Brazil. Ammonium nitrate price out of Baltic was supported by additional demand from the US and also active Brazil purchasing. Ammonia supply continued to be very tight both sides of Suez, but seems like long-awaited first sales from Gulf Coast ammonia plant took place last week. If so, it will help to ease the pressure to a certain extent. Phosphate price slipped more amid subdued demand across the globe. Natural gas price in Europe decreased again due to warm entrance to the winter season. Price in the US continued increasing amid colder than usual weather pattern and active LNG exports. Wheat futures dropped amid ample supply expected from key exporting regions. Vice versa, corn futures increased on the background of immediate product supply shortage. Soybeans price also climbed on the back of China purchasing more US tons. Container shipping rates decreased at all main routes as major pre-holiday shipments are already finished. Bulk shipping activity was vivid across most of the segments and regions. So, let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.